The U.S. debt crisis is a topic of growing concern, dominating conversations among policymakers, economists, and the general public. However, the reality of the situation is even more dire than most people realize. Let's explore the problem, its systemic causes, and the broader implications of government spending and global monetary dynamics in a structured manner. While mainstream narratives focus on deficits and debt accumulation, a deeper analysis reveals the true nature of the crisis and its consequences for the economy and society. The U.S. government, symbolized here as drunk Uncle Sam, spends far more than it collects in revenue. In practical terms, this means Uncle Sam pumps dollars into the economy through programs, infrastructure projects, and other expenditures, far outpacing tax revenue. Let's break this down. Imagine the government spends $8 but collects only $3 through taxes. This leaves a $5 shortfall. To cover this gap, the government borrows money by issuing treasuries debt instruments sold to domestic and foreign buyers. Private sector buyers, some entities and individuals within the U.S., purchase treasuries, attracted by their perceived safety and relatively stable returns. Foreign buyers, countries like Saudi Arabia, represented here as Average Mohammed, purchase treasuries as reserves or investments. Historically, these buyers saw U.S. treasuries as safe, reliable assets. Since 2009, U.S. debt has skyrocketed from roughly $9 trillion to over $35 trillion, a $25 trillion increase in just 15 years. For perspective, it took the U.S. more than 200 years to accumulate $9 trillion in debt, highlighting the exponential growth in borrowing. The U.S. debt crisis is not just a domestic issue, it is deeply interconnected with the global monetary system. To understand why demand for U.S. treasuries persists despite the alarming debt levels, we must examine the incentives of key players. These entities operate with a risk-averse mindset, prioritizing stability over high returns. U.S. treasuries serve as the currency of kings because they offer low credit risk, unlike private assets. Treasuries are backed by the U.S. government, which can create currency as needed. Liquidity and hedging opportunities. The global derivatives market allows institutions to hedge interest rate risk and currency risk, making treasuries an attractive choice despite inflation concerns. The dollar as the world reserve currency. The dollar's dominance ensures demand for treasuries. Global trade, particularly in commodities like oil, is conducted in dollars. Banks and corporations with dollar-denominated liabilities prefer to hold dollar assets to avoid currency mismatches and volatility. In times of economic uncertainty, the demand for treasuries as collateral skyrockets. Financial institutions need treasuries to secure interbank loans and transactions. This dynamic creates a self-reinforcing cycle where even economic slowdowns increase treasury demand. The real crisis: government spending and economic distortions. Contrary to popular belief, the U.S. does not face a debt crisis per se. The real issue lies in government overspending and the economic distortions it creates. Misallocation of resources. Every dollar spent by the government diverts resources from productive uses in the private sector. This phenomenon, referred to as a malinvestment by Austrian economists, disrupts market efficiencies, leading to slower economic growth and reduced innovation. Rising wealth inequality. Government spending disproportionately benefits asset owners while eroding the purchasing power of the middle and lower classes. For example, inflation caused by excessive monetary expansion reduces real wages and savings, widening the wealth gap. Social and economic consequences. Crime and theft. In the U.S., economic despair manifests in rising crime rates, as seen in the need to lock basic goods like nail clippers in stores. Homelessness and drug problems. Poor fiscal policies exacerbate homelessness and substance abuse, further straining communities. Global comparisons. Ironically, countries like Colombia, considered developing nations, often experience fewer visible economic distortions because they lack the same degree of government intervention. Why the dollar hasn't collapsed yet despite skyrocketing debt. The dollar remains strong and treasury yields remain relatively low. This paradox is due to several factors. The dollar's reserve currency status ensures consistent demand, insulating it from typical pressures faced by other currencies with similar debt levels. The Federal Reserve and other central banks play a significant role in stabilizing the Treasury market. If private and foreign demand wanes, the Fed steps in as the buyer of last resort, injecting liquidity into the system. For global financial institutions, there is no alternative to U.S. Treasuries. Gold, Bitcoin, or other assets may seem appealing but fail to match the liquidity, scale, and risk profile of Treasuries. While the current system sustains itself through foreign and institutional demand for Treasuries, cracks are forming. If confidence in the U.S. government's fiscal responsibility erodes, we could face a true debt crisis. As debt issuance grows, interest rates may rise to attract buyers, increasing the government's borrowing costs and creating a vicious cycle of higher deficits. If the Federal Reserve is forced to monetize more debt, inflation could spiral out of control, undermining the dollar's purchasing power and reserve currency status. Economic disparities fueled by government spending could lead to widespread discontent, further destabilizing the economy. Addressing the U.S. debt and spending crisis requires bold reforms, curtailing unnecessary expenditures and focusing on fiscal responsibility would mitigate economic distortions and inflationary pressures. Policies that promote innovation, entrepreneurship, and investment can create jobs and boost productivity, offsetting the negative effects of government malinvestment. Entitlement programs like Medicare and Social Security must be restructured to ensure long-term sustainability without adding to the debt burden. By demonstrating fiscal discipline and reducing political polarization, the U.S. can maintain its position as a trusted global economic leader. The U.S. debt crisis is a symptom of a deeper problem: unchecked government spending and its far-reaching consequences. While the global monetary system currently shields the U.S. from immediate collapse, the long-term trajectory is unsustainable. To avoid becoming a third-world economy plagued by wealth disparities and social unrest, systemic reforms are essential. Recognizing the true nature of the crisis is the first step toward meaningful change.